There is a bit of an obsession within the world of investing, and particularly among retail investors, with brokerage fees. At times, it can be astute and sensible to seek out lower fees, but there are also instances in which it can become a bit of an unhealthy obsession that leads to retail investors losing sight of the bigger picture. So I thought I'd make a quick video talking a little bit about some different types of brokerage fees and why they're not always necessarily a bad thing, and can even encourage better investing practices in certain circumstances. To start with, we ought to deal with what brokerage fees actually are. Just as when you take out a mortgage, you might have a mortgage broker, or when you take out an insurance policy, you'll sometimes go through an insurance broker, both of whom will charge a fee for their services, a stockbroker is no different. Also, just like those two examples, stockbrokers will sometimes charge you a set transaction fee, or sometimes they will charge you a percentage of your transaction cost, or, often in the case of online brokers, a hybrid of the two. There are multiple different types of stockbrokers, ranging from personalised services, where you will interact with an actual human being, they might have an office close to you, and they'll even be willing to assist you with other financial planning like estate management or will writing, to online stockbrokers, where you download an app, deposit your cash, and never interact with a human being throughout the entire process, and pretty much everything in between the two. As financial services have become increasingly automated, brokerage fees have come down significantly, making investing more accessible to those with smaller budgets and also making it more financially viable for people with less cash to invest, without having a significant chunk of their initial investment eaten away by fees. The vast majority of retail investors, and particularly new retail investors, use online brokers, who tend to have much lower fees, though there are still significant differences between brokers within the online and app-based arena. The types of fees that a broker might charge you include ongoing account management or maintenance fees, foreign exchange fees, ETF or mutual fund management fees, transaction fees upon the buying and or selling of stocks and shares, account closure or withdrawal fees, and in some cases there might even be account opening fees. Sounds like a lot of fees, doesn't it? In much the same way as financial professionals will often draw a distinction between good and bad debt, I would also draw a distinction between good and bad brokerage fees, or at least better and worse ones. If you are planning to invest passively through ETFs, mutual funds, or a combination of the two, then it is worth taking a bit of extra time to find the brokerage and the fund that is going to eat away the least amount of money on your returns. Even a relatively small difference in costs on funds can make a big difference over time. The Vanguard Group, the brainchild of Jack Bogle, was founded on this principle, and there is a good reason why it has become the largest provider of mutual funds and the second largest provider of ETFs behind BlackRock in the world, with $6.2 trillion in assets under management. A £1,000 investment compounded annually at 7.5% will be worth £37,189.75 after 50 years. If that investment had been put into the exact same mutual fund or ETF, but with a 1.5% management fee, its returns would shrink to £18,420.15 over the same period, a difference of £18,769.60 on your initial £1,000 investment due to what might initially seem like a fairly negligible management fee. In 2019, Forbes estimated that Vanguard's funds saved investors around $100 billion a year in fees, and they are no longer the only provider of low-fee ETFs and mutual funds. So clearly, if passive investing in funds is your game, which it probably is for most people, then scrutinising the fees of both your brokerage and your fund manager could reap dividends. In some cases, your brokerage and fund manager will be the same institution, such as if you hold Vanguard funds in a Vanguard account, but lots of people hold funds from different fund managers within a different brokerage account, in which case it is worth keeping an eye on both, as both are eating away at your overall return. This is doubly worthwhile because, particularly in the case of ETFs, there tend to be numerous different almost identical funds with wide-ranging fees. Almost every investment management company offers some kind of emerging markets ETF, most of which are virtually identical. The same goes for S&P 500 ETFs, and so on, In just the same way as when you're buying something online, most people will search for the best deal, it makes sense to do the same when it comes to ETFs and mutual funds because you're just looking to get the same product but for less money. Okay, that's great alpha, you might think, but the title of this video says why brokerage fees can be a good thing, and you just pointed out why they can be bad, and why you should take some time to try and get them as low as possible. As I said, there are fees worth worrying about and those that might not be, and it's the latter of those two that we come to next. Transaction fees, or dealing charges, tend not to apply to ETFs or mutual funds. You'll basically charge an ongoing amount for owning the fund instead. When you buy individual stocks though, whilst you will sometimes pay ongoing account management fees as a percentage of the value of those investments, you'll also often be charged an upfront dealing fee. In most cases, this will be a flat fee regardless of the size of your investment, but some brokers will charge you a percentage fee instead. I often find that it is these fees, even more so than fund or account management fees, that retail investors agonise over. This is where I think people are sometimes wasting their time. There are now a number of online brokers that offer zero fee or extremely low cost share dealing. On apps like Robinhood and Trading212, you can buy and sell shares entirely free of charge. That's great, right? Well, it is and it isn't. Whilst retail investors, and particularly new investors, have delighted at being able to buy and sell shares without any fees, in some cases, this removes all incentive, particularly for first-time investors, to keep hold of stocks and adopt a long-term investing strategy. You see, whilst dealing fees might seem like a pain, they often act as a deterrent, dissuading investors from making reckless short-term decisions. If the £11.95 dealing fee on Hargreaves Lansdown, or an equivalent broker with relatively high fees, is likely to dissuade you from making investment decisions you haven't thoroughly considered that are rather speculative, over time, that will likely save you money, despite incurring that £11.95 charge on all your other, hopefully, more shrewd investments. To give another working example, let's just say Jim is trading with 212, who have no dealing fees, and he invests £1,000 in Apple, which goes up 15% a year on average for 30 years. In 30 years' time, his share of Apple stock would be worth £66,211.77. Now let's take Alia, who invests with Hargreaves Lansdown, who have an £11.95 dealing fee. She also invests £1,000 in Apple, she also achieves that average 15% rate of return, and after 30 years, her investment is worth £66,199.82. The difference? Well, it's just that initial £11.95 dealing fee. As you can see, it's nothing like the huge difference that account and fund management fees can have over time. Jim has still saved £11.95, but that's pretty negligible in terms of his long-term investment. I should also point out that those figures don't take into account Trading212 and Hargreaves Lansdown's account management fees, since I was just giving an example regarding dealing fees. All fees should obviously be taken into account. If you are someone who is extremely well disciplined and you know that low or non-existent dealing fees will not make you more likely to engage in high frequency trading or poor short-term decision making, then scouring the market for the lowest possible fees may carry minor benefits to you. But if you think there's any chance that you could fall victim to buying the latest hot stock or following a friend's stock tip just because there's no dealing fee, and you think, well, why not? Despite having no knowledge of the business itself, the company's fundamentals, or what you might be able to expect in terms of a reasonable rate of return, well, a small deterrent like a relatively small fee, negligible over time but beneficial in the moment, then the right type of brokerage fees might actually serve you well. Certainly, I think a lot of people will be better served prioritizing things like reliability, usability, and customer service from their brokers over negligible differences in dealing, withdrawal, or FX fees. And certainly, almost everyone would be better off spending that time scrutinizing their actual investment decisions and the companies that they are investing in. No one who picks individual stocks ever looks back upon their investment decisions and says, if only there had been no dealing fee when I bought that stock, then it would have been a brilliant investment. Or, that was a brilliant investment for me because I only paid £3 to buy the shares. Once again, I must stress that I'm talking about people who want to actively manage their investment portfolios and pick individual stocks. and re-emphasise that for those who are investing passively in funds, fees will likely make a significant difference. And of course, account management fees apply to both and will make a difference to both. Anyhow, that is it for today's video, which I thoroughly hope you enjoyed, or at least found somewhat entertaining or educational. If you're wondering why I didn't show my face today, well, that's because we're many months into a lockdown in the UK, where hairdressers are shut, and I'm increasingly resembling either Jesus or a sort of 1994 Alexi Lawless. And if you're wondering why the images on screen were so sparse, well, that's because my day job, making videos about football, takes up about 85 to 90 hours a week, so sometimes when I'm making my one video a week for this channel, I can be a little stretched for time. But it's all about the content and not the visual stimulation, I think at least. Thank you all as ever for watching. Hit the like button if you enjoyed today's video, it makes a huge difference to the algorithm. Leave a comment if you have anything on your mind, and make sure to subscribe and turn on notifications, that's just by hitting the little bell, for The Reluctant Investor.